Well, hello and welcome to this brand new episode of Smart Money. As part of our Outstanding Women in Finance series, today we have Rupal Bhansali of Ariel Investments, who's going to join me in a bit. She's the CIO and portfolio manager of Ariel's multi-billion-dollar global equity portfolios. Ariel Investment has a total AUM of over $18 billion, and Rupal has, amongst other accolades, been featured on the list of the 100 most influential women in US finance. Let me welcome Rupal on board. Rupal, please join us.
Thank you for having me.
It's great to have you here, right here in the studios with us. And, it's been such a trying time, right, over the last many years. I mean, the pandemic has hit. You came out with the book as well, and here you are in India. How are you feeling?
Well, it's great to be back home. For 3 years, I could not travel. So while I wrote the book a couple of years ago, I really could not get to launch it. So I'm really, really happy that people in India, which is, my hometown, because I'm one of those people who went from Dalal Street to Wall Street. And in my book, I talk about all my learnings, my whole journey from this country to America. And I'm happy that I get to share it.
Oh, we are happy that you're here with us on the show. And, this is a part of our Outstanding Women in Finance series, right? And we like to profile women who are perhaps trailblazers in their own way, shattering the glass ceilings. And, in your book, I read that you've been born into, I guess, the equity markets. Your father had his own stockbroking business. So did it come very easy to you, getting into this business and then growing from there?
Actually, no. There were a lot of twists and turns as to what got me into finance. So since you started with my childhood, you're correct. I'm one of those few people, kids in the world, who grew up on stock stories, not fairy tales, because my dad was a stockbroker, and he would talk about stocks to his clients, and his office doubled as my bedroom, so I would overhear him talk. And of course, I didn't understand a word of what he was saying, but I was born in the 1960s. And back then, stock markets all over the world, including in India, were soaring. And so there was a lot of interest to invest in the markets. And being a broker, he did very well. So I was born, I would say, in a very well-off family. He put me in a great school. We had our own apartment. He was able to provide very well for his kids. But then the 70s came along, and the stock market crashed. And so did our family fortunes. And I was in this, Queen Mary High School, with, again, a great set of classmates, and they had a lot of things. They would do a lot of things. They would take vacations. They would buy things. And I would go home to my mom and say, I want this and I want that. And she would say, sure, when we have money. So I'm this 9-year-old thinking, what is this mysterious thing called money, and why don't we have it? So I was exposed to money because I didn't have it.
Okay.
And I learned at a very young age that the language of money is accounting. And I was very fortunate in my school. As part of foreign languages, they offered accounting as a language. Wow. Most people have French and other sorts of foreign languages. So I learned accounting when I was in school. And I think I've been speaking the language of money ever since. So that's kind of how it all started.
So you had great life lessons from the very beginning that has led you to this journey and eventually to this success, right? So tell us a little bit about, people move from Wall Street to Dalal Street to Wall Street. You've had a very interesting journey where you were brought up in India and then you went on to Wall Street. Now you live in New York. You handle the multi-billion-dollar portfolio of Ariel. How has the journey been for you?
Well, again, a lot of twists and turns because I really didn't have the money to go abroad. But I was very fortunate that the Rotary Foundation had an all-rounder scholarship. So I won it. And that's what allowed me to finance my education, in the US. I wanted to go to the US because if you are going to be a money manager, the sport of investing, if you're an athlete, you want to win the Olympics. And in the world of investing, if you want to be a great investor, you want to beat the S&P 500. So I knew I had to get to the US. And of course, Warren Buffett, my guru, is in that country. And so that's sort of what took me from Dalal Street to Wall Street. Okay. I would say that in terms of my journey, it's had a lot of different potholes, but every pothole I made as a stepping stone. I'm a big believer that, if you just... It doesn't matter that you don't have a mentor, you don't have a certain master plan, because I didn't have either. But I just started walking in the direction of my destination, and I got there.
Okay, that's great. This is, of course, a show where we provide a lot of financial literacy to our viewers. We have a lot of millennials, younger, the Gen Z, as we call it. They're, tuning in and learning about the markets. Tell us a little bit about what your expectation is from 2023. Do you think this is a market where India will continue to outperform while developed markets sulk? And what could the big growth triggers be for the next year?
So Sonia, I'm a very long-term investor, I think in terms of, a multi-year period, not any particular 12-month window. But nonetheless, I do understand a lot of investors want guidance. I'm quite skeptical of this bull market rally continuing. I think it's actually a classic bear market rally. I would remind investors that when the NASDAQ fell from 2000 to 2002 by about 78%, it had 7 20% plus bear market rallies. So one should not get seduced by these rallies, which of course suck a lot of people into the markets again. Fact of the matter is valuations are very rich worldwide. It's not just the earnings multiple, it's the debt multiple, which few people actually care about or think about. But corporate debt worldwide has gone up a lot, including sovereign debt. And deleveraging tends to be very painful, and it causes a deflation in the multiples that people are willing to pay. So I'm actually quite bearish on global stock markets, but that includes India for 2023. That said, not everything is lost. One can position portfolios, even for a market that's going to go down. And I would say that historically, whenever we've had what I call a lost decade in stock markets, for example, in the S&P 500, we had it between 1969 to 1978 and 2000 to 2010. What a lost decade means is that the stock markets end up lower than when they started out, which means you see capital depreciation, not appreciation. Now, during those times, if you own dividend yielding stocks, they tend to help you out a lot in compounding capital. Dividends actually, in the long run history of stock markets, account for almost half the total returns. So I think people have forgotten that because there is so much money made through capital appreciation that people forget dividends play such an important role. So I think it's time to come back to the basics to look for those dividend yielding stocks.
Okay, look for dividend yielding stocks. Perhaps 2023 is going to be a year when equities doesn't perform that well. So that begs the question, right? How do you position your portfolios in such an environment? You spoke about dividend yielding stocks. Do you also look outside of equities, maybe into fixed income, debt, gold, given that there are macro concerns?
So I would say that for a very long time, people said, it's tea now. There is no alternative because interest rates were so low everywhere in the world. But I think now that has changed. Even in the US, at the short end of the curve, you will still soon be able to make 4%. And in India, I think you can make almost 8% in the fixed income markets, without taking any duration risk. So I think the short end, literally parking your money in 2-year T-bills is not a bad idea. Cash can serve as a dry powder such that when markets correct, you have cash to be able to put to work. So it cuts both ways. And these dividends that I talk about start generating cash flow for you so that you can reinvest. So I think it's sort of a twin track. Put money in fixed income, but don't take duration risk, be at the short end of the curve.
Just trying to play the devil's advocate here from an Indian investor standpoint, right? Because despite the kitchen sink thrown at India, India has sort of come out and hit record highs. Inflation is cooling off as well. You have the macro situation that's improving. Do you think even if global equities continue to underperform and don't generate alpha, India could be a different ballgame altogether?
I wish. And I'm sorry to be the bearer of bad news here, but I would say, while I'm very bullish on India for the long term, there are lots of secular drivers and a lot of unleashed potential in the country. I think when it comes to equity markets, just like in real estate, it's about location, location, location. In equity markets, it's about earnings, earnings, and earnings. And I think that because of a global recession, I don't think India will be immune to it. And I think earnings growth will be quite challenged, and that will cause a deflating of the multiple. And when you have the combination of the two occurring, where you have a decelerating earnings growth or a decline and a multiple compressing, markets tend to go down, not up. Again, this is a very short-term view in terms of a correction. I think long-term, one of the secular drivers for not just India, but the emerging markets at large is actually this notion of inflation, which has everybody worried and caused the markets to fall. I think COVID and the move to the cloud is something that has been underestimated as a source of benefit to all emerging markets, including India. In fact, India led the way. 25 years ago, 30 years ago, we started exporting services. Before that, a lot of countries, everybody thought you export goods. And China, of course, is a big exporter of goods. And that caused inflation to come down because that was a way to create disinflation in the world. Low-cost countries produced goods at a cheaper and cheaper rate. And that helped out a lot, the global economy, but also inflation. Now, inflation has moved to the service sector. You know, it's a labor shortage, it's wage inflation, it's blue collar. So blue collar work got outsourced. Now white collar work will get outsourced. So India can be a very big beneficiary of that, just like it was in the IT industry, but now it will go beyond IT. You'll have white collar work, office work, doing secretarial work, data entry, clerical work. There's just a whole bunch of work, that can be outsourced, because during COVID, remote working became more acceptable. And beyond that, a lot of companies have moved their processes and information to the cloud. So this is why I said the COVID and the cloud is actually a huge benefit to emerging markets, but it's a long-term story, not a short-term one.
Okay, well, let's do one thing. Let's take a quick commercial break. On the other side of the break, we do want to talk a little more about Rupal's book, the big takeaways from an investment standpoint, and of course, what it means to be a woman, a successful woman in this big bad world of finance. We'll come back in just a bit.